Hey everybody, Preston Brent here with our weekly roundup brought to you by our trader user group. This is for the trading week ending Dec 21, 2018. How many of you are familiar with that song, Santa Got Run Over by a Reindeer? A lot of you are. I mean, I know as a kid I heard that all the time. They still play it on the radio. I think more appropriate in this common time frame right now, or this economic environment, it should be Santa got mauled by a bear. Remember I told you a few weeks ago, October was the worst month since 2008. You know, it was down. I think Jerome Powell set it all off with his speech early October. October was down a little over 7%. Dow was down over 5. NASDAQ was down 9% for the month. November was relatively flat, and now there's December. Everybody was hoping for a December year-end rally, hoping that Santa would show up, but I think Grinch came in and took all the presents, and to make it worse, the bear came in and probably scared off the reindeer. So Santa's sleigh is stuck for the moment. Um, we've seen December work out to be the worst month so far, and we're not even over with it yet, since 1931, the Great Depression here in the United States. That's just how bad the month of December is. Last week, by the way, was the worst week since 2008. So we're certainly racking up the records here in the market, but not the kind of records we want to see unless we're short. Now, some of the strategies that we're using, our anchor trades and everything, are really set for down markets. So we're doing fairly well in our group. As a reminder, if you're not a member of our group, I highly encourage you to come in because next year is going to be probably, we're going to still have a lot of headline risk. I'll talk about it in a second and we'll go into the charts. But there's still going to be a ton of headline risk with some events coming up. Um, well, I've got a good holiday special for you guys, and I'm going to throw in 1 hour of private time with just me, so we can sit there and look at your portfolio, and I'll give you some ideas on things that you could probably do, whether you do them or not. But I could certainly help you out. But looking at the current markets today, um, this past week there was no sector that came unscathed with this huge downdraft. Really a bad week. We saw XLB, the best performer for the week, but it was down 3.18%. Utilities was pretty close behind that. Even utilities got shot down this week. And the worst performing sector was discretionary, is down a little over 5.94%. The PE ratio is still continuing to drop. It's down about 14.65 for the S&P. That's below the longer term running average. December of this year, 1 year ago, and a look back, the PE ratio is at 22.64. So we've seen the PE ratio, and this is forward earnings guidance, has been reduced by 35.28%. So I would suspect, as we normally find when we have a market like this, some buyers are going to start to get interested in a lot of securities, good stocks that have really taken a beating. And let's not forget the VIX. I mean, right now, it's been really kind of an interesting move up in the VIX. Normally, you get these explosion higher type of moves in a flush out kind of environment, and then people rush back in. But we haven't seen that this year. The VIX has just been steadily moving higher. The VIX closed this week up 52.8%. It closed up to 30.11. Last week it was under 20, 19.58. And I think a lot of analysts were looking for the VIX to at least get up over 30 to scare the children. But we haven't had that flush out moment. And that's not to say that it won't come. I do believe the markets, the volatility markets now are a little bit different than they were earlier this year when we had the VIX pop up to 50. Everybody was on the short end of the stick with volatility going into February of this past year when the markets crashed. And all of those shorts had to be unwound in the VIX volatility or the futures volatility market, and there were huge orders coming in after the markets closed, and it was inefficient, and that caused the huge spike in VIX, the huge spike in volatility futures, and the forced liquidation of XIV. Okay, now as a reminder for you members out there, this coming week is a holiday week. Equity markets are going to have about a half day shutting down at 1 o'clock Monday, and then obviously on a full day Tuesday in observance of the Christmas holiday. Most major indexes countrywide are going to be closed. And then we pick things up for a very quiet time between now and kicking off January. So lower volatility with the high frequency traders and algos programmed in. It could be a little bit choppy, but volume is going to come down dramatically. Okay, so just kind of keep that in mind. Cash is also king in the market right now. I was checking the dividend yield. The average dividend yield for the S&P as of this Friday's close is about 2.31%. Now check out the 13-week. That's over 1/4 of a T-bill. The interest rate for just 3 months rather is sitting at 2.42%. You can get a higher yield on a 13-week T-bill than you can get in dividends and stocks on an average now. So a lot of money and big money that may buy an index fund, a dividend fund that buys a lot of stocks to average out dividends. They're like, why take the risk? Why not just go into cash or go into a 13-week T-bill, make more interest, and these are considered risk-free kind of investments. Normally, you want to see the T-bills a lot less, so you've got to, but there is no risk premium in the markets right now. So we're seeing cash being king, meaning a lot of that money that would typically go into equities is coming out and going into short-term T-bills and then being rolled over as they come due until this market settles down just a little bit. Okay. I mean, this past week we saw over $2 trillion in market value just wiped out. And I think a lot of it, in my own personal opinion, is the Fed policy statement. Hiking the rates 25 basis points. Yeah, it would have been nice if he didn't, but the markets had that priced in. I think the big issue was the way he communicated his message for 2019, and primarily around the autopilot statement for quantitative tightening on the U.S. balance sheet to the tune of $50 billion a month. I mean, that was just horrible. I was watching tick by tick in the S&P 500 E-mini futures, and when he said those things, the market sold off dramatically. I mean, we were actually up on the day. The S&P was up, the Dow was up, the NASDAQ was up, everybody was up. And then when he opened his mouth and the way he communicated, it was not good. So I think they're going to try and undo that. It was another forced error by the Fed chair. He's relatively new, but I don't know what data they're looking at, but they're going to have to come out of it. We saw this past Friday where the New York Fed governor attempted, I guess, to undo part of what Powell said. The markets rallied, the Dow rallied 300 points. And then Navarro came out from the Trump administration and said, finishing the China trade deal by end of Q1 is going to be very difficult, and then the markets, the Dow went from 300 up to like 400 down. It's almost a 600, 700 point reversal. I mean, these people just need to learn that what they say affects the markets. And if you can't say it smartly, then just put duct tape on your lips. I mean, really. So that's what we've got looking at. I still do not believe that we're going to go into a recession next year. So if we go into some of the markets, like NASDAQ was into a bear market down a little over 22%. The Russell was the first to move into a bear market, and then we've got both the Dow and S&P not in a bear market, but close. But we could fall into a bear market without going into a recession. I don't think we're going to have a recession next year, but I can tell you, you can have the technical factors, technical indicators put the market into a recession because you'll have this selling, which sets the mood. And not just of the consumer, but of businesses spending money on CapEx spending. And everybody's going to withdraw and come back in. And then the spending stops, the hiring stops. And that's what the Feds could really screw up here. Or the Trump admin can screw up with the China trade tariffs. So next year is going to be all about headline risk. Literally, I mean, most analysts are not forecasting a recession, but just as the thing I saw in Barron's this weekend, which is really interesting, the beginning of 2018, the 100 least popular stocks that had the lowest analyst buy ratings on them, I think they averaged 17% of a buy rating on the 100 least popular stocks. They finished the year up 3.6, 3.7%. And then the top performing stocks, the 100 stocks that had 77% buy ratings in early 2018, they on average finished down 3.6%. So that just goes to show that institutional analysts, they can be rat brain as well. There's a herd mentality where everybody gets the buy rating and everybody loves the stock. They drive the price up. It gets too far away from valuation and multiples. And then the minute the markets have a hiccup, guess which ones fall the hardest? Those guys do. And then you get analyst down ratings, and that further accelerates the downside. When you have few stocks that have very little buy ratings, then the upside is probably a higher probability than a downside. So that's a little bit about that. But we've got next year. I think the year is going to be all about headline risk, meaning there's only two things that can impact the economy and move us into a recession or not. One is the China trade tariffs. And that's going to be a headline risk thing because it's on again, off again. And hopefully the Trump administration understands that and is a little bit more nuanced in how they deliver news. But that could be an issue. An issue in 2019 that could affect corporate earnings, margins, CapEx, capital expenditures, inventories, which affects GDP, a number of these things. And it adds a lot of risk to the market, what I call headline risk, where something can come out like a Trump tweet or an interview with Navarro, someone on the trade team, or someone from China, and boom, the markets are off on a rally, 300 up or 300 down, and you're trying to scramble to say, what the hell happened here? And then the other big thing, and it's going to come up in Q1 of next year, is Brexit. So these negotiations, if it's a bad Brexit deal, meaning it's a hard landing kind of thing, that's not factored into the European markets yet. And if they have a bad hard landing, that's going to wash to our shore. And the way the algos are working, again, it's a headline risk kind of thing. So we've got to be very careful in the first half of the year. If we can get through those, then I think the year is not going to be a bad year because fundamentally the economy's sound. But we can drive it into the dirt if we try hard enough. And that seems to be what everybody's doing right now, at least the Feds and the Trump administration. So now, looking at the chart here, I've got a daily chart of the S&P 500. You can see it on the screen. We're at the lows on Friday, we were down 18.25% on the S&P E-mini futures. That's a big move, okay? I mean, a really big move. And where can we stop? Well, if I put it on a weekly chart, just to kind of give us some value areas on here with these, where all the volume tends to be sitting, you can see right here, way up in this area here, right around the 2018 open is going to serve as a huge overhead resistance point. Okay, I mean, just a huge overhead resistance point. And then if we come down here and look, we've got another resistance point right around 25.32 area because there's very low volume here because we just fell so fast on this. I mean, you can see this week here it's just straight shot down. And then you can see this value area here around 24.28, which is about where we fell to. So that's going to, this is going to be an area that we can hang out at. If this breaks and we go lower, then the next value area for us is all the way down to around 2062. Keep in mind, there is a longer term upsloping trend line that is going to help us out a bit. Now we can come down to this trend line sooner and be in a bear market, but without, with strong fundamentals, this would suggest that we're still going to get a bounce probably if we move lower, I believe. But you can see the upsloping trend line. This goes all the way back to 2009, March 2009. So this is kind of where we're sitting right now. And then if we break the upsloping trend line, like I said, there's not a lot to stop us from coming down to about 2000, 2100 area. Not a lot at all. I mean, we could come down to the 2150, except the psychological barrier of 2300, 2200, 2100, those kind of things. But there is just this huge move up since the Q4 of 2016, and we've just blown through all of this, and now we're giving a lot of that back up. Okay. And if I really just kind of move out here in time, you can see the upsloping trend line going all the way back, right? So this is going to serve as a pretty good support area for us. And we'll see whether we hit it or not. Now, within our strategies, we're doing well with what we're doing and how we're playing it. But for those that are long stocks, you're getting hurt. And even those that are short, sometimes you're having a hard time playing the short side because you get out too soon or you try and trade a counter trend move and you just get chopped out. Same thing with the downside. So it's a difficult market to play. But we're running these essentially long vega, long gamma from an options perspective. So we want to take advantage of this volatility, although we are at an extreme here. I'll show you the vol skews here in just 1 minute, volatility skews. And if we look at NASDAQ, um, you can see here with NASDAQ, we're, and I didn't even mark it on here, but we're at we made this new low here. And if I look at the NASDAQ composite, which is, kind of all the stocks in NASDAQ, you'll see that we're down in the lows right around 22.48. Now we're up just slightly off the 2018 low, but you could see that huge move. You can see the value area sitting here right around 6,400. So if we can get back up above that, perhaps we'll stay there for a bit. But really a lot of damage has been done. Should this area break, then there's not a lot of volume at these prices here to just stop us from really giving it up. The other thing that I find interesting is look at the Russell. I mean, the Russell, we'll look at the RUD index. You can see here we're down 25.98, call it 26%. There's a little bit of a value area here around the 1228 area, but folks, that is huge. I mean, it's hard to believe we're at 2018 highs and all-time highs back in August. Now, this was the first one to give it up. And since August, we've fallen 26%. That's some unwinding. And you could see all these value areas here where we kind of hung up a little bit until we got right here. And then this to me looks more like a panic kind of sell than anything else. Okay. And then if we look at the Dow, and let's look at a weekly chart of the Dow, you can see we're down at the lows here about 17.05. And then looking at it on a daily basis, you can see the huge move down. I mean, just the watershed movement for this past week has just been ugly. Coming out to the weekly chart, you can see here again, the value area here, we've got a pivot here, a pivot range running around 22,000 down to about 21,000, which would put us into a bear market. Okay. So I'm expecting a bounce, but as I've been telling our members, since about the second or third week in October, we're in a sell the rally mode, full tilt boogie, and we're trading as if it's a solid bear market. And for all practical purposes, price action is acting that way anyway. So, that's kind of what we're doing. Our strategies in a bear market, work out nicely for us. And this is kind of what we're playing it with right now. If we look at the tracking index for China, ASHR, I mean, China is down 37.86%. All right, 37.86. And if we look at the Russell, again, just as a reminder, the RUT is down 25, or 26. So about 8 percentage points different between the Russell and China. You would have thought a lot worse. Now look at emerging markets. Emerging markets is down too, but only only 27.84%. We're in a bear market in emerging markets across Europe. Other economies are not doing as good as the U.S. The U.S. was really the leader, and then with this past week, it gave it all up, but we're still leading, but not in a good way. And, when you have an analyst say, well, the good news is we lost less than other people, that's really not good news. It's really bad to make a statement like that because you still lost money. But you can see the results here. Now, if we look at volatility for a second, and let's just look at the VIX here real quick. You can see I color code my chart just for options purposes on, different strategies play different in different zones of the volatility market. We tipped into the red zone briefly on Friday, and you could see that we moved up and we closed Friday at 30.11. Folks, it's going to be hard. I mean, very difficult to maintain this level. Even if markets crash, they will consolidate at some point. And during that consolidation process, the volatility gauges come down. Even if it doesn't, the markets don't really move up much, volatility will come down. I think we've got a lot of headline risk and a lot of algos that are keeping VIX up. And that's not to say that we can't spike up higher. But I do believe that we're, this is a time now to look for some juicy fat premiums in some stocks here or in the SPX market, depending on whether you have a Reg T or a portfolio margin account and how you can play these things. And if we look at the front month skew, look at the front month skew. I mean, we are literally in the red here. And if we look at this front month skew, it's the skew is 6.11 points. That means the VIX is higher than the January vol futures contract. That's the front month now. We changed over this past week. When the VIX is higher by 6.11 points, that is a lot of fear in the market. The normal skew is that as you go out in time, the volatility is just a little bit higher to accommodate risk over time. But when the skew reverts back and it goes backwards, as they call it, backwardation, then the VIX and the front month is higher than you going out in time. It's ugly. This is ugly. This is in the red. This means there's a ton of fear. And then let's look at the back month skew, which is January against February. It also, look at the explosion here. This means the January volatility futures exploded relative to the February volatility futures. Now, this one here affects VXX. VXX plays January versus February volatility skew. And when you get a skew like this, you get a roll yield in VXX. That's a positive roll yield, meaning it tends to move VXX higher, not lower. So it's negative for people looking to play VXX to the downside. So when you get a skew up like this, the tendency is for it to come back in a little bit. So that's what I'm going to be expecting over time. Okay. Now, if we come in and look at U.S. Treasuries, and let's just look at bonds for a minute. Bonds obviously are giving the finger to the Feds and the Powell. Bonds moving up like this, what happens to interest rates? They move down. Even though you've got this Fed saying they're going to have they've got their dot plot where they anticipate 2 hikes next year. I think they'll be lucky if they get 1, maybe 1, and that's about it. And not in Q1. And remember, next year, the Feds in their meeting, they meet in January and then they skip Feb, I believe, and then meet in March. Every meeting is going to be a press conference. And every meeting is going to be data dependency. And I think you're going to see in the coming week or two before the next Fed meeting, the governors are going to get out there and try and talk up the markets. Like the New York Fed governor did. Keep in mind when they do that, the market's going to react very positively. A big part of this drawdown is what the Feds did. I think it's more critical with what the Feds are doing than what the China trade tariffs doing, quite frankly. That's moving markets big time. It's widening the credit spreads between junk bonds and investment grade bonds, and that didn't really happen earlier in the year, and it did here, and it spooks the markets. And if we look at interest rates, right, here's the 10-year. Look at the 10-year. It's now coming down to my bigger support area. If I put it on a weekly chart, just to give you guys an idea, you can see we're just slightly below a big value area on the weekly chart. I could probably just draw a trend line here, right, and just kind of put it like right around there. So I think we're going to have a hard time breaking this. If the Feds come out and they reduce their interest rate forecast for 2019, that could possibly move the rates even lower, move the dollar even lower as well. And the next value area takes us back down to 233. I don't think we're going to get there, but I do believe we could come down to the 274 area, right? So the interest rate market and the bond market is saying 2019 is going to be a lot slower Feds than you think. And we want you to adjust policy. Okay. So that's a little bit about what the interest rates are saying to us and what the bond market is saying to us. Now, for our members, we had an hour and a half session just on quantitative easing and quantitative tightening, what it means for the U.S. balance sheet, how it affects liquidity, the Treasury auction market, and even if you don't trade this, you've got to understand this stuff because it affects the equity investments. Think about it this way: money drives everything. Liquidity drives everything in these markets, not earnings multiples. That is a factor, but there are two things that drive interest market price, whether it goes up or goes down. One of them is interest rates and earnings per share and interest rates. And interest rates affect earnings per share, all right? And when interest rates start moving uncontrollably fast in one direction or the other, the markets tighten up. Liquidity goes away, bid-ask spreads get wider, it costs you more money to get in and out of things. The mark-to-market is a lot worse, and it just makes the market much more formidable for anybody that's having a trade run against them. It forces margin calls, and then it forces all asset classes to sell off because people are meeting margin calls. So you've got to be conscious and understand the credit markets, whether you trade them or not, because it does, as I said, affect the equity markets dramatically. Currencies, well, if we look, the US dollar is really the strongest one in the batch. You can see here it's near its 2018 highs. All the other currencies are relatively weak. We're at a support area here with the US dollar. It came down to a support area. You can see the market map on this as I blow this up. I think the dollar is going to be in a trading range for a while here. Should the Feds come out and be more dovish and they kind of reduce their two rate hike scenario next year to maybe one, or the markets anticipate that, you're going to see the dollar come back down. All right, and it's going to come back down, probably down, in my mind, down to around 9.4, 9.7, the index. And that would be bullish for the euro and others. If we look at the British pound, this is going to be an interesting one because of the Brexit. You can see here, I still want it to go even lower. If I put it on a weekly chart here, just to plot the value areas on the screen, you can see here there's a value area sitting right here, which is kind of where we came down to and found support. But we could come down to the post-Brexit lows fairly easy. I mean, if we blow this thing out, you can see here the post-Brexit lows right here at 120. And that's kind of where we're headed to. In fact, I think we're going to take that out before we're said and done. Once we get down there, then I'm going to start dipping my toe in the water in longs on the pound, because I think over the next 2 or 3 years, the pound is going to be back up over $1.35. Because remember, before the Brexit, the euro or the UK was the strongest economy all across Europe, and slightly behind that was Germany. So once they get this all sorted out, the pound is going to scream higher. But with the pound going lower, their imports are going up, and it could bring inflation to the forefront, which is going to force Mark Carney, who is our equivalent to our Fed chair. He runs the Bank of England. It's going to force him to raise the rates, and it's going to push the pound higher. So that's a little bit about what I'm seeing in the currency market. Energy, my gosh. And our members did great in this, those that were on our bandwagon. Right up in this area up here, I was calling for shorting the oil. And if you guys remember back up here, Goldman was saying oil is going to go to $100 a share or $100 a barrel. And I said, there's just no friggin' way. And I was calling for oil to come down to the low 60s. I did not call it to come down here. But nonetheless, it fell, and we had members taking this trade, and it's $1,000 a point. And it has moved, all the way from, in the mid to high 70s down to 45. It's $1,000 a point per contract. So it was a great trade for a number of our members that took the trade, even if you took it in USO. It was a great trade, right? So here's oil now. Now the big question is, okay, et tu, Brute, what now? Well, if we come out and look at it on a weekly basis, my next point was right here, right to 48.68. and we didn't hold up here. You could see the value area sitting here. We came right down to this area down here, okay, which there is a lot of support in. If I move it out, you can see the value support area. It came down to this value area that we had back in September of 2016. So I don't see too much more downside. And we blew right through this trend line. I think the true value area of oil, once they sort all this out, is in the high 40s to low to mid 50s. So give it about a 10-point range. And I think any move much lower, it's more on the global growth story than it is on demand fundamentals of supply versus demand in the oil markets. This is kind of where oil, initially it was supply issues and the Iranian thing, because this kind of happened as Iran, Trump did that deal with other countries, and it really flooded the market with inventory. He did that on purpose. And now it's going to take probably 3 to 6 months to work all that extra oil inventory off the books. And with the slowing of the global economy, that's just going to make it a little bit longer. And of course, if we look at gasoline, I had the same issue with gasoline. I said short it. And you could see here like this, you could see gasoline. We went all the way, we've blown all the way through, and we've hit, going back to 2016 value areas. I mean, just really low. So gasoline also is overdone. So I believe we're going to settle in down around these areas down here. I don't see a lot of downside. I do see some really fast counter trend moves, but there's so many shorts in this market. Any counter move is going to be a sell the rally kind of thing for the near term going into Q1. Remember, gasoline futures seasonality shows February, March, and April very bullish for gas, because it's a seasonal driving period when refineries switch over to summer stock, and that could be a really good way to play gasoline. You could play it in the gasoline futures market, which can be volatile at times, or you can play UGA, Uniform Golf Apple, which is a great way to play gas. If we look at the spread between Brent and WTI, you can see it really kind of fell off the table here. I was hoping the spread would get back up in here. We traded this one up here to the downside. The spread, I think, right now is probably a little bit easier to trade than oil or Brent by itself. It's a little bit more forgiving. I think over time the spread is going to come back in between the price of Brent and WTI. If we look at gold, as I've been telling you guys, gold is in a very slow um, um, move higher. And as I always draw this out, and I'll do it again so you guys can see it, it's got one of these kind of rounded bottoms, right? I mean, it's classic textbook, cup and handle kind of pattern like this. So we're probably, if the markets forecast lower rates than the 2 Fed dot plot, interest rates down, that will be bullish for the dollar, for gold, because it's bearish for the dollar. And if the dollar pulls back, gold is going to continue to move up, probably into this range right here, around that area. We got a value area there, and we stuck here for quite some time before we broke out of it. So we could have a little bit of a move up, profit taking, and then move up to this area here. Typically, when you break this area here in a cup and handle, you generally move up 10% before you have some kind of market dislocation that pulls it back a little bit. And this is a great trade in the futures market, to just sell puts out of the money out of here. And you can get way out of the money here. The calls up here, the volatility is a little bit higher. So sometimes doing a 1x2 to the upside here, where you're long 1 and you're short 2. And you have to be careful how you do it. But you can manage these trades, because as gold moves up, you're getting a lot of knuckleheads coming up here and buying all these calls, versus maybe less puts down here they're buying all these calls, and all that does is jack up the volatility in the out of the money calls. Hence doing a 1x2 or maybe a 2x3 kind of ratio, where the downside, it's a risk-free trade, and the upside, you make money unless it blows up big time. Because the markets are forecasting lower interest rates, this gives me this makes me say that gold is going to continue to drift higher. Okay. Now, A way to play gold also is GLD, or you can play GDX, which are gold miners. You can see the gold miners tends to be a little bit of a faster moving chart than the futures market. So if you look at gold miners here, you can see the next value area for gold miners is up here around 2237. It's sitting at 20 now, so about a 10% move higher in gold miners. You can see this big drop off. All we're doing is making back up what we gave up here in the summer months. Okay. So that's a little bit about what I've got in metals. Palladium, of course, it's been on fire compared to gold. But as I said, it got overextended here. And a downside correction is clearly warranted here. I think this could come in a little bit more. Okay. Oh, one other thing I forgot to talk about in energy, and that reminds me, is natural gas. Nat gas got really extended up here, okay, and then it went into this triangle, and we went short here because, unlike a stock, a commodity that gets extended like this to the upside generally favors downside movement, and I think it's still going to come back down to around 3.25. So you could do UNG to the downside, or you can do nat gas. It's very volatile in the winter because if you've got a warmer winter, then gas should be back down in this area down here around below 3. But it's still elevated up a pretty good bit, which means we could get a pretty fast move up here if we have a big shot of cold air. But if it does, I'm going to be looking to sell it. So we took our profits in this trade on this past Friday. So what I'm hoping is for another big blast higher. And then once I see it rolling, we'll jump right back into it again. Okay. We got things going on in agriculture. I'm watching the softs and meats. If we look at the ratio chart, you'll see here TLT is outperforming the S&P dramatically. So this, when it's going up like this means money is leaving equities and going into bonds. And when they go into bonds, bonds rise, interest rates go lower. So there's no doubt that this kind of ratio trade has worked out really nicely for those that know how to do the pair trades, with TLT being long and the SPYs being short, right? And then another one, here's gold. Gold, you can see, is outperforming the SPX dramatically, right? So we've seen gold outperforming. Look at utilities. Utilities is also outperforming. So we've got bonds, utilities, gold. Are you seeing a pattern there, guys? These are risk-off assets that money is flowing into out of equities. Look at healthcare. Healthcare has also been moving up, albeit not as dramatically, but still money for most of 2018 has been coming into the healthcare market. Now, let's look at some that have been underperforming. If we look at IWM, the Russell to the S&P, the Russell has been in a severe bear market compared to the SPX. And this basically is not a vote of confidence of the U.S. economy. So when you've got a severe move like this, we're going to get a snapback rally. I can't predict when it's going to happen. But, going long IWM and short the SPY on this relative ratio chart could be a real interesting thing. Look at banks. Banks is another one that has been slowly moving lower. We had a little bit of a lift in banks as it looked like interest rates are going up, but then starting in the middle of November, banks gave it all up. Okay, so we've got that kind of play. And then, of course, if we look at technology, you can see here technology really since August, end of August, has been giving it up versus the S&P. So on these relative charts, they're really good. Oh, one other one that I wanted to show you here too. Let's look at transports versus the Dow. If you look at the transports versus the Dow, transports have been underperforming the Dow since September. So generally transports leads the Dow by, anywhere from 30 days to 90 days out. So you can see that severe underperformance. So it was almost like a heads up that October could be pretty ugly. And now we're way down here. Again, a snapback rally could be in the works here, which would portend a snapback rally in all of the major indexes. All right, everybody, that's kind of where we're sitting. Again, if you're a member, we're going to have our weekly market watch this Sunday. We're off next week, and then we'll pick it up the first week in January. If you're not a member, I highly encourage you to come in. I'll include an offer, our year-end Christmas holiday offer, where I'll give you an hour of my time, and we'll take a look at your portfolio, and I'll have you fill out a trader survey just so that I can get your idea of your performance, see if I can't help you out in that short period of time. If you come on and join up with us, I think you'll be happy with what we're doing. All right, everybody, I will see you guys later. If I don't talk to you until next Sunday, I guess I won't. Have a really good, happy holiday season, Christmas season, whatever you observe, just enjoy it. Have fun with friends and family, and I will see everybody later. Members, I'll catch you this Sunday evening. Take care, folks. Ciao.